Thank you, Amity, for that generous introduction and limiting deposit insurance to actually insured deposits is a radical concept. Now, going with Amity's Chanel metaphor, Coco Chanel said in the 1920s that simplicity is the keynote of elegance. Now, she was not talking about financial markets, but she may as well have been, as hopefully, if I do my job right, you will see at the end of my little talk. So, a failure of free markets. That is what the last 2 years look like to many people. We've had the financial system destroy itself so thoroughly that the government had to come along and provide it with essentially nationalization of all of its risk so that money and credit would not disintegrate. Now we have unemployment and underemployment at 17.5%, but yet Goldman Sachs says that it has to pay at least $16.5 billion worth of bonuses so that its own employees don't leave the firm. Now, Goldman seems to feel bad about this. It wants to donate $500 million to small businesses. What kind of free markets do we have when small businesses have to depend on rich companies treating it as a hobby in order to get capital financing? But this, in fact, has not been a failure of free markets. The past 25 years are the story of what happens when a government does not understand its proper role in the free markets. And that is to provide a level, predictable, consistent system of prudent regulation so that markets can discipline themselves without causing unacceptable harm and destruction to the broader economy. Now, we know how to do this. We did this for 50 years, more or less well, from the 1930s until the 1980s. How did we learn how to do this? We learned the lessons of the 1920s. Now, the 20s were a wonderful, innovative decade, as Amity has noted in her own work. The problem with the 20s as it relates to financial markets is that innovation creates optimism, optimism creates excess optimism, and when you have financial markets that don't have any meaningful regulation other than monetary policy, you have financial firms and regular people borrowing against every last dollar of optimism projected decades into the future. You've got layer upon layer of debt upon layer of assumption going out into the future, and that means when you have the slightest falter in profit expectations or some other expectation of the future, you're pulling out one level of assumption, the whole tower of assumptions and debt collapses. And then you have so much unpaid debt that the banking system is effectively bankrupt. We saw this happen in the early 1930s, not just with borrowing against the stock market, of course, but against all kinds of asset markets. And what did we learn from this? We learned that markets have to discipline themselves, but not at the price of unacceptable destruction in the economy. So the first elegant solution to this puzzle of how to allow market discipline without economic destruction was the FDIC. This is acceptable moral hazard, where FDR and his policymakers decided we can eliminate panic or reduce panic in the financial system by protecting small depositors, but we're not going to protect bad banks against their mistakes. They can still fail. It's just that these small depositors will be protected so that we will not see the destruction of money and credit again. But the most important thing that FDR realized was that you don't want to eliminate risk in the financial markets. You just want to protect the economy against the natural, inevitable excesses of optimism and pessimism. How do you do that? You limit borrowing, first of all, and you limit borrowing predictably and consistently. FDR did not set up a systemic stock regulator to figure out which stocks are safe, which are not, which ones you can borrow against unlimitedly, and which ones you cannot. Instead, they said that the Fed and the SEC would say you can only borrow half the price of a stock. You can speculate all you want, pick your own risk, but when you are wrong, you will lose, but the economy will not be bankrupt. And then they also said you've got to consistently report market activities, corporate activities, so that people have a level fighting chance of understanding what risk is out there if they choose to do so. Now, this system worked well again until the 1980s, and then the financial system started to escape prudent regulations and escape market discipline, and we are going through the result of that right now. So, how did this happen? We go back to 1984, May of 1984, a bank called Continental Illinois. This was the 8th largest bank in the country at the time, and Continental Illinois was a pioneer of sorts in the banking industry. Continental was a pioneer in that it did not follow a business model of solely keeping long-term loans on its books, booking the profits as people and companies repaid the loans, and having a very slow business model, insulated for the most part from acute panics and fluctuations in prices in the securities markets. Instead, Continental purchased loans that had been securitized. That meant that they were vulnerable to fluctuations in prices day to day, and Continental booked the profits from the fluctuations in those prices. That's one way that they made themselves, and they multiplied over many financial institutions in the future. They made the system of credit more vulnerable to financial excesses. The other way was that they depended on short-term financing. Uninsured short-term lenders provided a good deal of their money, so they made themselves vulnerable to short-term panic in a second way, because these short-term lenders could pull their money out overnight in a crisis. Now, the government in 1984, the market started to panic in the spring once they got wind that some of these securities that Continental had were going bad. The government decided that Continental could not fail, that the price would be too high for the national and indeed the global financial and economic system. So the Reagan administration did something that was unprecedented at the time. They came out, the FDIC, Treasury came out and said that none of Continental Illinois' bondholders, the uninsured bondholders, they would not take any losses in the Continental failure. And this engendered quite a debate within the Reagan administration. Don Regan, who was at the time the Treasury Secretary, said, he wrote this in a memo to his colleagues, "We believe it is bad public policy, would be seen to be unfair, and represents an unauthorized and unlegislated expansion of federal guarantees and contravention of executive branch policy." So he was against this. President Reagan himself never said much publicly about the bailout, but an unnamed White House official said that the president's thinking was that he agreed with regulators' compelling argument that the only other choice was to risk worldwide financial havoc. So this is a sign of things to come. At the time, Fed Chairman Paul Volcker said that this bailout would not set a precedent, but the markets knew that it set a precedent. We got a new phrase in the financial industry, if not yet in the public lexicon, which was too big to fail. And the Independent Bankers Association, which represented small banks, understood the implications of this. Its president at the time warned, "These big banks have the ultimate anti-competitive government subsidy. They are too big to fail, and regardless of how mismanaged they may become, the buck will stop with the taxpayer." So, when the government wants more of something, it subsidizes it. If you want more corn, subsidize corn. If you want a financial crisis built up over decades based on the banks and other financial companies borrowing for the purpose of reckless speculation, then subsidize banks and other financial companies borrowing for the purpose of reckless speculation. And that is exactly what the government did with this new policy. Banks and later other financial institutions could borrow at rates that they could not have otherwise borrowed at, because their lenders knew that this was in effect lending to the government, but at a higher interest rate.